There's a blue line and a red line. I've shown this many times on these videos, and now we have finally crossed the threshold where the blue is above the red. The red is bank reserves. The blue is the amount of cash being traded, the amount of reserves being traded for Treasury securities every day. You can see that we have broken through $3.2 trillion on the blue line, and we have broken below $3 trillion on the red line. So there's more reserves being traded than reserves that exist today. How is this possible? I don't know for sure. I suspect central clearing of part of that cash flow is responsible, meaning if there is a clearinghouse that is canceling debt between several parties that owe debt to each other, the volume is measured as all of those banks paying loans to each other, whereas the debts are canceled out if there is a central clearinghouse. So some of the volume that is being traded does not actually exist, which is why I believe that we are over 100%. I don't think this can continue for long.
The substantial repo compression of September 2019 remains a benchmark for market participants. The Federal Reserve did not monitor the situation until the crisis. Central banks are becoming more proactive and cautious. Recent operations show the Fed leaning in earlier. Is $30 billion or more for the intervention significant? Not yet compared to previous peaks. The scope may extend if liquidity difficulty persists. We are at the start of the cycle, not the end. Start with a Bloomberg article, probably from October 31st. Headline: Flashing Global Money Markets. Warning indications of liquidity depletion. Jerry Powell is in the backdrop of a photo of a man with a lot of red light on his face, discussing money printing. This image resembles Joe Biden's "Get Off My Lawn" scene, with two guards and red lights. The U.S. resembled the Soviet Union for a few months, causing alarm. This image brings back memories. In addition to the U.S., the U.K. is losing liquidity. We should investigate how this is happening. In the same article as this headline and its image or caption, the article's center chart, it claims funding demand is at an all-time high. Regarding the Bank of England, this is like UK repo rising for a week. The Bank of England lends this much to short-term borrowers. It's nearing £100 billion. This graph ends with this brief rise. This indicates liquidity restrictions in the UK, as in most of the world. The reason? One reason is that the Treasury's bank account, as of October 30th, has topped $1 trillion. A trillion-dollar note, the largest ever. Institutions lack that money. This contributes to SFR repo tightness. Banks and other financial organizations trade Treasury securities for cash. If they cannot, they borrow from the Federal Reserve. Pressure on finance markets comes from several sources. Banks and dealers are circulating large amounts of Treasury collateral and currency. Treasury settlement flows and tax payments are depleting reserves, and repo rates like the secured overnight financing rate have risen above the Federal Reserve's reserve interest rate. These patterns signal that reserves are becoming scarce. Thus, market participants are urged to use the Federal Reserve's standing facilities. The Federal Reserve's staff noted that quarter and month endings worsen these limits. This is happening now.
Like if 2019 and what happened at the end of that year was a planned operation to print money, something like that is going to happen again soon.
When will then be now? Soon.
If you believe in that stuff. Anyway, let's get into the slides. And of course, before anything very big happens, you might want to take advantage of the recent consolidation in gold and silver prices to get your gold and silver at Miles Franklin. Take your gold and silver that you have and put some of it in a Dirty Man safe. Link in the description below. Use code ENDGAME10 at checkout for 10% off. And if you want a more detailed description of what is going on now in the aorta of the monetary system, check out the Endgame Investor at Substack. Link in the description below. Let's get to the slides. First thing we have is an article from Bloomberg. I think it's from October 31st. The headline is Global Money Markets Are Flashing Signals. Liquidity is drying up. You have a picture here of some guy with a lot of red light on his face with Jerry Powell in the background talking about printing money or whatever it is that he's talking about. This is a picture that is reminiscent of that get off my lawn scene with Joe Biden with these red lights in the background and two guards that made the US look like the USSR for a few months, and it was very scary. This is what that picture reminds me of. But liquidity is not only drying up in the US, it is drying up in the UK specifically as well. Let's see how exactly this is happening. In the same article, with which this is the headline and the headline picture or caption or whatever, this is a chart that appears in the middle of the article. It says funding demand surges to a record. This is talking about the Bank of England. This is the equivalent of 1 week repo surging in the UK. This is how much money is being circulated by the Bank of England to those that require short-term loans. It is nearing 100 billion pounds. You can see this short surge at the end of this graph. This is a sign of liquidity constraints in the UK, which is being reflected in most of the world. Why is this happening? Well, one reason is that the Treasury's bank account, the amount of dollars sucked up by the Treasury, has broken through $1 trillion as of October 30th.
The largest denomination currency ever, a $1 trillion bill.
That is money that the banks do not have, and that is one of the things that is causing tightness in the repo and the SOFR market, the market where banks and other financial institutions trade treasury securities for cash with each other. And if they don't have enough, then they go to the Fed for that cash. Now, this is what is happening now. There's a blue line and a red line. I've shown this many times on these videos, and now we have finally crossed the threshold where the blue is above the red. The red is bank reserves. The blue is the amount of cash being traded, the amount of reserves being traded for treasury securities every day. You can see that we have broken through $3.2 trillion on the blue line, and we have broken below $3 trillion on the red line. So there's more reserves being traded than the reserves that exist today. How is this possible? I don't know for sure. I suspect central clearing of part of that cash flow is responsible, meaning if there is a clearinghouse that is canceling debt between several parties that owe debt to each other, the volume is measured as all those banks paying loans to each other, whereas the debts are canceled out if there is a central clearinghouse. So some of the volume that is being traded does not actually exist, which is why I believe that we are over 100%. I don't think this can continue for long, and this is why. We are already at the stage where the central bank, the Federal Reserve, has to provide the missing cash itself because there's not enough reserves to go around. There's only 2.85 trillion, whereas there's 3.2 trillion in reserves being traded every day now. And that is why some of this money has to be.
The Federal Reserve has indicated a pivot in response to the tightening of markets. It declared that it will cease quantitative tightening, QT, on December 1, 2025, and will refrain from making any additional reductions to its balance sheet. In the interim, the Standing Repo Facility, SRF, experienced record utilization of more than $50 billion in a single day. These actions indicate that the Federal Reserve is attempting to maintain the functionality of funding markets while simultaneously addressing inflation. The repo market's susceptibility as a gauge of broader stress is emphasized by the change.
Supplanted or supplied by the Federal Reserve. We saw this in the headlines on Twitter and other social media networks a few days ago that the central bank, the Federal Reserve, has printed $50 billion, and now it's printed over $20 billion, and this is huge and it's never been this high. Well, that's not exactly true. It has been this high. It's been much higher. We're going to go to the next chart to show you that these headlines that are saying, or these tweets that are saying that repos have never been this high, not true. I wouldn't say they're lying, but they're being a little bit misleading.
Are you high? What? No, I'm not high. Why would...
You are high as a kite.
I'm not high.
So this is the same repo situation post-repocalypse. You can see it starts here on the left side on October 2019. So just before that is September 2019. And that is when the repocalypse happened, when repo rates went to whatever it was, 10% overnight. And then the Fed had to act immediately after. You can see at the beginning of this chart, there are no repos. There's no blue lines in that little margin at the beginning of the chart. But then it starts at around September 17th over here, and it's about $50 billion where we are now. It's between 40 and 60. You can see this first bar over here. But we had been above that line following that date many times. It was consistently above 50 billion, not every single day, but pretty much from September 2019 to about December 2019, it was usually above $50 billion in daily repos. It dropped off a little bit in December and then January 2020. And we all know what happened here. The lockdowns of infinite wisdom and compassion. That's what I call them because, yes, they were. Wisdom and compassion personified in the lockdowns, which saved the entire planet. And I won't say anything else about that. So you see here, the record for repos was actually $152.75 billion on March 17th, 2020, when the lockdowns were instituted. So when people say that 50 billion in repos is an all-time record, it's never been this high, it's not true. It is true that the standing repo facility that they have now has never been this high, but there's no economic difference between a standing repo facility and a repo facility that's on the fly. It's all the same thing. Dollars are dollars. It doesn't matter if you're standing there or sitting there or lying there or flying there while you're doing repos. Doesn't make a difference. Repos are repos, and they've been higher. When will this finally spill over into the rest of the markets? Well, I don't know, but I can tell you that the weakest part of the markets that have been the weakest since since treasuries started to fall and interest rates started to seriously rise when the Fed started hiking interest rates, that is the commercial mortgage-backed securities market. Of course, lockdowns would be pretty bad for those things because when you lock down, people stop going to offices to work and they start working at home, and then that becomes a habit, and then the office real estate isn't worth much because nobody's going to it anymore. Nobody wants to renew their leases. So we have here from TREP. The TREP CMBS, commercial mortgage-backed security delinquency rate, resumed its climb in October 2025, jumping 23 basis points to 7.46%. We'll just read a few paragraphs here. In October, the overall delinquent balance rose 1.1 billion to 44.6 billion. That's about the size of the Madoff Ponzi scheme, which was 50 billion. All 5 of the major property types saw increases in their respective delinquency rates. The largest rate increase was seen in the office sector, which soared 63 basis points in October to set a new all-time high of 11.76% after retreating by over 50 basis points the month prior. Earlier this year, the office delinquency rate hit new record highs of 11.08%. In June at 11.66% in August, both now eclipsed by October's new peak. So we see office CMBS getting worse and worse and worse. And now that culture has changed and offices are no longer in demand because of the lockdowns of 2020, the wisdom and the compassion of those lockdowns had the unintended consequences of making office buildings almost worthless because nobody goes there anymore. Anyway, one more sentence here. The second largest rate increase was in multifamily, which rose 53 basis points as delinquency rates to 7.12% and topped the 7% threshold for the first time in nearly 10 years since December 2015. So, how much longer until something in here implodes? Can't be long now. We're already at record highs in office delinquencies. Now, there are so many bubbles that still exist because of the money printing of 2020. And the one that I follow closely is actually the Bitcoin bubble. You can't even call Bitcoin really a bubble, and I'm waiting for all the comments below to tell me how I don't understand Bitcoin. Well, that's true. I don't understand Bitcoin. I have no idea what it is. And you know what? Neither does anybody else, because it's not a thing. It's just a code to an empty safe with an empty safe inside of it, and so on and so forth, until you get to the final empty safe, which has nothing in it. But anyway, this is Bitcoin in gold terms, how many ounces of gold it costs to buy 1 Bitcoin. And the high we can see is still back from October 2021. And yeah, it was briefly broken for about 2 weeks in late 2024. but that breakout was a false breakout because it could not follow through. And we see the triple top was confirmed here. And now we are at the trend line that has been in place since the end of the crypto winter in 2023. If this trend line is broken decisively, we have the final line of resistance at about the 200-week moving average at 22 ounces of gold, just below 22 ounces of gold. Once this falls, that should be the signal that all the other bubbles are popping. And the Fed is going to have to print a lot more dollars to reflate everything. Everything will be reflated, including Bitcoin, except the only difference is that the thing that's going to go the highest, the fastest, going to climb the fastest is going to be gold and silver. And everything is going to become a lot cheaper in terms of real money as the value of credit falls and falls. What I'm saying is that there is one more printing round ahead of us. We were in the repo stage of that, and we saw in 2019 only took a few months from September 2019 to about March 2020. What is that, 5-6 months to initiate the next printing round this time?
Therefore, what is the next step? The baseline is for a slight reduction in pressure, but not a complete alleviation, as the Fed is currently suspending QT, injecting liquidity, and closely monitoring repo usage. The risk is that funding strains may resurface or worsen in the event of a new shock, a surprise fiscal event, a political tax disruption, or another external shock. In the interim, this instance may serve as a precursor for credit-sensitive assets, precious metals, and even cryptocurrencies. Another printing cycle could be necessitated by the subsequent stress, which would favor tangible assets. However, the timing remains ambiguous. The primary objective is to monitor the central bank signals, reserves, and repo market.